Welcome to the Investing Success Show with Brian Patton. I'm here with my co-host Adam Whitmire.
Back again.
Phillip Christian with Gibraltar Real Estate Services. Welcome to the show.
Thank you. Good to be here.
So Phillip's an old friend of mine and does commercial property management for commercial real estate, among some other things.
And development, right?
And development.
Yes, and development.
Yeah. And we'll talk a little bit about, I guess, all those things if you like to. But wanted to have you on the show today, talk about, let's start with your property management. So how long have you been in business doing this? And
We started almost 20 years ago managing our own properties and properties where we were partnered in deals with other investors.
okay, and what kind of properties?
A lot of medical.
Mm-hmm.
Did a lot of deals with doctors, small suburban medical stuff, retail, some retail, and then typical office buildings.
Okay. All right. So you've been doing it quite a while.
And you're mostly here in Georgia? Is it southeast or?
Yeah, Metro Atlanta for the most part. A lot up in Gainesville, Hamilton Mill, Alpharetta, Roswell.
Near the hospitals?
A lot of it's near the hospitals, yeah. Not all of it is. So we're not really on-campus developers. That's a
Gotcha.
little bigger group. We don't play in that sandbox too much. We're kind of the off-campus. Your ambulatory surgical centers, the things that are in the suburban locations.
Now you do the property management and the development. And is there a difference between those two businesses? In other words, do you do property management, I guess, on a retail scale, or is it just your own properties that you're managing?
We started off doing just our own properties. That's kind of how we got into business. It kept us connected to our tenants. We knew what was going on. We knew who was doing well. We knew who needed more space. We did it just because we felt it helpful. We started doing it for a few clients who were either former clients or former partners that we'd done other deals with that we may not be involved for the very same reasons. Once we kind of got that under our belt, we started picking up kind of organically, to use a very overused term. We just grew a little bit till we turned around a few years ago and realized we were, whether we wanted to be or not, professional property managers. And we started picking up other properties and doing it and marketing that as part of our core business.
You know, here's one thing probably a good portion of our listeners are not corporate property owners. They're probably mom and pops that own one or two or three or four properties. And one thing that I've seen from working with these folks is that, you know, when you look at property you're either doing the property management or you're paying somebody to do it, right? It's there is work to be done managing property. It's not, we talked before, it's not, real estate is passive. It's considered passive, but that doesn't mean you don't do anything.
It's not really passive.
Yeah, there's nothing passive about owning a commercial property.
Right.
I use the example to a lot of my people who don't understand. Property management is to property investment what an offensive line is to a football team. When they do their job, nobody notices anybody but the quarterback. Offensive line is invisible. Mm-hmm. Let one guy fall down, and the quarterback's going to be next, and that's all anybody sees. Property management is the same way. When you do your job, property is clean, looks good, rents are paid, happy clients, happy owner, nobody notices you're there. It makes it kind of hard to market sometimes. The better job you do, the least noticeable you are.
Mm-hmm. And that offensive line or the property manager always makes that quarterback look good if they're doing their job.
That's
What
it.
always irritates me, you know, my wife's an Alabama fan. They always have a great offensive line. I mean, how hard is it to be a running back or quarterback behind that offensive line? It's like number one offensive line in the nation always. I'm a Mississippi State guy. And we don't ever have the number one offensive line.
No, you don't.
So it's a little harder to be a good quarterback or a good running back behind a
it is. If you've got a good line, it's like to his point, Philip's point, if you have a good property management company,
it goes unnoticed.
Everything's great. But if you have a bad property management company, you're going to notice immediately.
And it's not just rent. It's not just one thing. Your property may look bad, but property management is so much more involved in that on a day-to-day basis, you know, knowing your clients, you know. And if you lease to a big medical group, your check may come out of Birmingham, but your tenants are there on site. Those are the people that are using your facility every day. Those are your real clients. That's who you need to be focused on.
So what are some of the challenges in managing commercial real estate like that?
what's not challenging
if
about
there
it.
are any challenges,
You just collect checks. That's all.
Yeah.
right? It's pretty easy,
no
right? Just about
challenge.
anybody can do this, right?
The most challenging thing is the last few days of the month when all that money you collected on the 3rd is gone. No, the most difficult thing is probably dealing with bad tenants
Yeah.
or tenants who can't or won't pay their bills, because it's such a lose-lose proposition. Everybody feels like you don't pay your rent, we'll just kick you out. Well, you're definitely not going to collect any rent once the guy's out of the building,
Sure.
and that process will take you 60 days. So he's probably not going to pay for those 2, plus the 3 months to get it released. So counseling your clients about the real cost of certain things.
That's half
the real
year
cost
right there.
The real cost of vacancy. That reminds me of a story. If I can throw it in, I self-manage a lot of my properties. A lot of them are residential investment properties. And one time I had this tenant that decided he wanted to cut down a pine tree in the front yard. Don't know why to this day. So he cut it down. Of course, what happened? It went right through the middle of the duplex. Almost killed somebody that was taking a shower. And so we got it fixed and all that with the insurance. And somebody asked me, "What did you kick him out? Did you evict him?" I said, "No, he's like one of the best paying tenants I had." So the vacancy, it wouldn't do me any good to kick him out. And then I got a vacancy I got to pay for. So sort of same thing. Vacancies are a huge problem for that's the number one expense of landlords, because you got vacancy, you got to re-up it, you got to release it, you got leasing commissions, you got to put some money back into it. So
And it just takes time. That's
a lot of time, especially in the commercial realm. I mean, we're talking a commercial vacancy can last months, 6 months, a year.
I literally we've got a problem tenant in a property, and I say problem. He's been there 10 years. He's just changed his business, and his cash flow is peaks and valleys, we'll call it right now. Good guy other than that. Communicates with me, lets me know what's going on. We have new owners on the property, and they're like, he's the only non-medical in this group. Well, we'd like to get him out. I said, okay. Do you understand what the cost is? Well, $50 a foot to build out 3,000 feet for a medical guy.
Yeah.
Plan on 6 months of no income. Plan on a new commission for a 5-year lease at $20 a foot. These are the numbers. This is the reality.
And 6 months to lease it up after you
right.
get
Well,
them out,
right.
at least.
So those are what the real costs are. And I guess this is way in every job. Teaching your clients what's real and what's not real is a hard part of the job, because they don't do it every day. What makes sense to us makes no sense.
Which is why they have you there to help explain to them, hey, here's what happens if you decide to go this route or that route, and here's how it affects your portfolio or your business or your cash flow. And so in a lot of what you deal with is medical office buildings, like you said. Where do you see the pros and cons are between medical office as opposed to retail or industrial or even residential or something like that?
The tenant improvement and the turnover. Turnover is much higher with a retail group, but your build out is much less generally. The benefit to typical office or even medical office is probably less turnover. But the cost is a lot more when you do.
So you're talking.
So you don't want to
$50.
have turnover, really.
No, you don't want turnover.
So
but if ABC hair salon takes some space, the build out is not significant. And if they're replaced by AT&T cellular store, their build out's not. So the only real problem you have there is the time that you're empty. In the commercial side, whether it's office or medical, so much longer period, and build outs are so much more specific to include walls and toilets and break rooms and things you just don't see in retail.
So you're probably talking in the medical side, $50 to $60 a square foot for build out. On the retail side, $20, $25. Does that sound about right?
Yeah.
Okay. So you're talking 2 to 3 times as much tenant improvement. And for our listeners, typically a landlord will pay some portion, sometimes all, of the tenant improvement allowance for a new tenant. So you got a new tenant, they're signing a lease, but we got to reimburse them for construction cost of X number of dollars per square foot, and that's what we're talking about. Normally under retail it's $20, $25. It's all negotiable, but $20, $25 a square foot. Under medical office, it's $50 to $60 a square foot. So that's where the vacancy turnover can cost the landlord a good bit of money.
Yeah, because it's so much more to get them in. And what are the duration of those leases on average?
5 to 10 years.
5 to
would be
10 years.
typical.
So you're gonna have a tenant in there for 5 to 10 years.
In retail, you're 3 to 5 years typically, unless
Gotcha.
it's a
So it's a
restaurant.
short amount of time.
Mhm.
So if any way possible, you don't want a tenant to move out. If you can do anything to make them happy,
That's it.
obviously you accommodate that.
That's why the management's so important. A professionally managed building. I have no real stat, but my guess is has less than a third the turnover. Tenants don't care.
It's the little things that add up, right? You
Yeah.
know, pine straw wasn't put on this side of the building, and if they got a landlord they're trying to deal with, and he's off to Jamaica, they're off here, and you can't reach him, and they get to the point where those little things
Yeah.
start adding up. And like I said, it's not a big deal, but you start adding those up over a 4 or 5 year period. The tenant starts thinking, well, this landlord doesn't care about me. But if you got somebody like Phillip who's professionally
watching.
managing it, who they can reach at any point during the day, during business hours, or even sometimes off business hours, say, hey, we got this little issue. It's not a big deal, and he takes care of it. That makes that tenant a little more happier.
And you're
A little
happier
more
if
happy.
you're off, doing whatever it is you're doing, because it's something you don't have to deal
Right.
with, and they're keeping your tenants happy, and they're keeping that income coming in.
Mm-hmm.
So how do from the professional property management on that level, how do they usually charge? What is that range? Is it basically just a management fee?
It's a management fee that is based on the percentage of income. So that would range between as low as 2.5% on maybe an industrial or what we call an absolute net lease property, where you're doing very little of the on-site management, to 4% on a typical office building. As the buildings get larger, that comes down a little bit, just like a sale commission or a leasing commission may come down a little bit based on
It's interesting,
size.
and that seems pretty similar, even with a number of different types of asset classes.
Yeah.
Of, the 4%.
The real benefit is on most smaller commercial buildings, almost all retail buildings, property management in the lease is a pass-through cost. So one of the things I pitch and let people know is, a lot of owners don't even charge that back. So if they're self-managing, doing real work, they could be paying themselves a fee and billing it back to the tenants in a CAM situation or an additional rent, or they could be paying somebody to take those 2 a.m. phone calls when squirrel runs in front of a motion detector and the police are on their way to your building.
That's a good point. So if they're doing, I assume that it's got to be obviously a lease point in the CAM, but if they're doing their job, then they should be able to get that reimbursed from the tenant. I like that.
Well, it's in most leases.
Right.
Interesting. So do you feel like that medical office is a good asset to invest in right now? Or
Adam's got about $10 million he wants to invest.
When do you kind of get nervous about where we're at, in the market and what's going on?
Medical REITs have really pushed cap rates down in some areas, but the institutional stuff has a very specific checklist. Has to be very close to a medical campus, has to be certain construction, and that kind of stuff is pretty hard to buy right now, to be honest with you. It's very safe.
What kind of cap rates are you seeing?
True institutional stuff, you're still seeing some things in the mid sixes.
Mm-hmm.
The off-campus stuff, more along the lines of our building up at Bald Ridge Marina across from the Costco. Off-campus, close to a hospital, not on there. We're in the low sevens.
And what kind of financing are people that are buying this kind of product? What kind of financing are they bringing? Is it just local bank financing?
Most of the stuff we deal with is local.
Excuse Excuse me. So they're at 5.5% maybe interest rate at the moment.
Yeah, owner occupied is in the mid 4s.
Mm-hmm.
Investment grade is high 4s, low 5s right now.
Okay. So call it even 5%. You're talking really only about a 1.5 spread between the cap rate and the interest rate. That's pretty minimal. Back in the day when I was first learning the CCIM stuff, they said 2% sort of what you want to target. So
Spread on the development.
yeah, spread on the difference between the cap rate and the interest rate, and that's how you make your real money as an investor is that spread. So what are your thoughts on cap rates? Should we see them moving down any or moving up or?
They're so dependent upon the interest rates, which of course dependent upon the T-bill,
Mm-hmm.
which is of course dependent upon so much going on right now. I don't think we're going to see much change from an interest standpoint. I think we are seeing enough new product. I mean, for the previous 5 years, we've been in catch-up mode.
Mm-hmm.
And a lot of older product is now being reconfigured. If you go over to Gwinnett Hospital, for example, some of the big buildings over there have been emptied out, some voluntarily, some involuntarily, reconfigured, and they're filling back up again. So I don't think we're going to see a ton of movement in cap rates. I think the interest rate is going to keep them compressed,
Mm-hmm.
but I don't think we're going to see much getting better.
One thing that's always concerned me as an investor and as a real estate broker is when you're selling properties with these I call them compressed cap rates. Maybe they're not compressed anymore. Maybe that's where our market is. But when you're selling or buying properties in that 6.5 cap rate range, my concern is what happens. You got a 5-year call or 7-year call on your financing or refinance balloon. What happens when the rates are 6%? Or 6.5%. I mean, you could very well, unless your rents have gone up much, you could very well be in a negative cash position if you're not careful.
Yeah. You take that opportunity to turn it full circle. That's why you want your building managed. As big a problem as that is, when you have to reconfigure your debt in 3, 5, 7, 10 years, it's a much worse problem when you have to reconfigure your debt and you've got 28% vacancy.
Or you need $50 a square foot for half your building is vacant. And
that's it.
Where are you going to come up with that money? You're going to refinance that back in the deal, and there's not enough equity in it to finance that back in the deal.
The good investors that we're dealing with or that we see, not over leveraging.
Mm-hmm.
It's not 2008 anymore, 2007
Yep.
or 2005 when we were doing 100% loan to values on.
So what do you recommend on loan to value for an investor in that?
It totally depends on the investor. I wouldn't go anything above 85.
Mm-hmm.
I think you're playing with fire when you do that. I think if you can keep it in the 70 to 80% range, then that helps that spread, so to speak.
Mm-hmm.
I think you leverage enough to benefit it, but you don't over leverage your spread.
Right.
And we've got several lenders in town that if you can get it into the 65% range, they'll go non-recourse with you. They'll underwrite the real estate.
Just on medical, or are you finding they'll do that on other
Medical.
stuff?
Medical is what we're seeing most of it in.
That's pretty big. Not non-recourse.
Yeah, that's great.
Donald Trump. I've read several of his investment books, and he says don't ever personally guarantee a note. Never. Don't ever.
Yeah,
Which is hard to do.
It is, but you can still do
Or
it.
hard not to do.
Yeah, you can still do it. It depends on the size of the deal, and
Mm-hmm.
a lot of times the bigger the deals, there's a lot of opportunities for non-recourse. A lot of our projects are non-recourse. Cash flow projects or multifamily projects, and some of the land development projects. Mostly things with cash flow. When you get into assets or projects that don't cash flow, some of the development projects that we have, it's harder to do that. But for the most point, it's way better to go non-recourse if you can do non-recourse.
Absolutely.
For sure.
Yep.
But then again, nowadays, some of the non-recourse, they have bad boy carve-outs and clawbacks or this and that. It almost looks recourse. So you really got to read the fine print anyway, especially if it's a non-recourse.
Well, the bad boy clauses have always been there. Or at least I've seen them since the 2000s.
Explain to our listeners what you mean by bad boy.
Because basically, as long as you don't do anything intentionally, do anything illegal, then
So if you do something illegal, they can have
that
recourse against you.
they can have recourse against you
Mhm.
if you're doing something illegal, basically. But some of those look a little bit different, so you really have to read the contract.
By the way, if you want to read more about cap rates and what some of the stuff we'll be discussing, mailboxmoolah.com.
That's right. Brian's got a good book about all that.
I got to say that 7 times, mailboxmoolah.com. That's what all the
Awesome.
marketing says.
Putting the 7 times. So then you're covered.
That's right.
7 times per show. That's a lot.
That is.
So that's a lot. So interestingly enough, it's all like your book says, Mailbox Moolah. It's all about. There's another for you. It's all about cash flow.
Yeah.
At the end of the day, it's about cash flow, and liquidity helps being able to buy at an opportune time. Right now, like Phillip said, it's tough to buy deals where you're competing with institutionals
It is.
because there's a lot of capital in the market.
Well, they've got a lot of cash too, so
And
they're not constrained. What we're talking about earlier,
Yeah, there's
where that difference between the cap rate and the finance and the interest rate. They're not constrained by the interest
No.
rate because they don't have any interest.
No. And there's just a lot of money in the market right now. There's
Mhm.
a lot of money in the economy right now, and it's being spent on things and development and growth, and things are happening. Even though the economy, toward the end of last year, the economy's been kind of stabilizing a little bit. A lot of people thought that, oh no, are we at that next cliff? And so a lot of talk is going into the fact that we're at the end of a cycle.
Mhm.
Where are we at? And ultimately, like you had mentioned, people are being more conservative on leverage. They're not leveraging as much. They're not using debt as much, and they're just
And long
trying
term,
to
that's
mitigate
good.
that risk.
That's really good for the
Yeah,
market long term.
absolutely.
Yeah.
It is. So I think I think most experienced investors right now are being more conservative and using less debt.
Yeah.
And I think that'll benefit them long term. They're not trying to go for great high cash flows because, let's be honest, the market is not producing significantly high cash flows right now.
Mm-hmm.
We don't have that growth that we had. It's just basic. It's a stable market.
Right.
So like in our portfolio, we're just positioning, right? So if we pick up cash flow, flowing assets, we're just cherry picking, trying to find good deals that we think are good, stable, long term, but trying to maintain a good cash position. So as the market adjusts or corrects, however it needs to, there'll be more buying opportunities as we go into a buyer's market sometime in our future.
That's a good
Hopefully
point.
there'll be one in our future soon.
Maybe you should write a book.
I should
Some
write
good,
a book.
good stuff there.
You know what? I'm going to put that down.
Phillip, appreciate you joining us today. How do people reach you if they want to talk more with you?
Go to our website, gibraltarinc.net, or they can reach me at 678-234-9926.
You can reach me and Adam at brianpattoncommercial.com. Also, what's your website, Adam?
Whitmire Capital Advisor.
WhitmireCapitalAdvisors.com.
Yep.
Okay. This has been the Real Estate Success Show with Brian Patton and Adam Whitmire. Thank you for joining us. We'll see you next time.